Hey, good afternoon. It's Friday here in London, and I thought I'll give a couple of news, especially when the market is opening green just now. But the three stocks I want to focus today is Master, SOFI, Apple, and then I'll end with the memory game. When I say memory game, I'm talking about AI data center memory. Why is the hype so big? So let me begin with the first three stocks and maybe perhaps the one SOFI. I've done my buy trigger update for these three stocks, SOFI, Mastercard, and Apple, which just completed their earnings. And I believe that folks will be keen because one, SOFI is a very popular retail investor stock because it's under 20 bucks and is the best bank of the year, and the fact that there's potential for prime growth. Second, Apple, one of those classic ones where many people own the stock. We know that it's been going sideways for a while. Google and NVIDIA has taken the throne, but what is the prime game after the earnings? And finally, Mastercard, I just want to say it's buy trigger. Very rare opportunity for the buy trigger. So these are the three segments I want to cover. SoFi earnings came out, the share dropped about 16%. When I look at the data, the detail, the business, it's on track. Business is on track. What more can you do with a growing bank? You're not selling ice creams where you can expand by the number of trucks. Yeah, maybe banks, you can expand the digital providing of new asset class, better app, trying to entice more younger people in. But the game plan is Robinhood, SoFi, Interactive Brokers, or any other banks, the big banks, there's only so much people you can grow within a country. The country needs to grow. Unlike in South America, where you got a new bank, which have got 80 or 120 million subscribers in comparison to 12 million on SoFi. So we cannot compare apples to apples on a growing country versus a first world country. So SoFi is doing what it does. At 36% growth, SoFi is one of the highest growth bank in US just now. There's no expansion across anywhere else. But SoFi is doing what SoFi is doing. So I don't understand why people are upsetting that it's dropped 16%. But for me to add value to you guys is SoFi's value trigger, meaning what I calculate what SoFi is worth as of today at 36% growth. SoFi is worth 11 bucks on value trigger. And if they sustain this for another year going forward, keeping track of the record, they'll be worth 20 bucks in the short-term future, like the forward PE. So $11 now, $20 in future. At the moment, SoFi is worth 16. So it's in the right zone. It's just slightly overvalued for now, but it's encroaching to next year's value. And it's a growth company, 36% growth. And of course, people say SoFi should be a $30 company. Yeah, that's in future. That's in 27, 28. So be patient when you invest. Investors are seeing that there are other opportunities elsewhere. The memory game, data center, the weight loss stocks, so people can rotate. So I'm not going to lose sleep on SoFi. 20 bucks is the buy trigger. You can buy the future value, which is in fact 22 after I calculated. $11 buy trigger. So no loss sleep. Don't fight with anyone online. That's SoFi. If it's 30, it's overvalued, trim some down. Simple. Now, let's move on quickly to Mastercard, okay? Mastercard, Visa are one of these stocks, staple stocks that I put on the BuyTrigger database that I analyzed, that I've been monitoring for years. This Mastercard is a 16% growth. Value trigger just now is 427. Price is 503. So there's about a $70 difference, okay? My buy trigger that I allocate with the fundamentals, the premium that I put in is 520. So where I'm coming from is Mastercard is currently undervalued. Very rare to see Mastercard pull down. I know Visa has gone up 5%, Mastercard has dropped 5%. In fact, they're the same kind of game, Amex, okay? They're all the same. Every bank will offer one or two, and do you really care whether it's a double V or that logo that you see? It doesn't matter. It works, it does what it does, and that's all we care about. So Mastercard is undervalued. If any of you think that, oh, why am I buying Mastercard? It's because it's a staple stock. On the pyramid, it's a staple stock. It's one of those recession-proof stock. You heard it from me, recession-proof stock. We've seen COVID, we've seen the war, blah, blah, blah. Mastercard is still there. Unless the only way to destroy Mastercard is two things. Okay, we get World War III, the nuclear weapon just goes, There's no banks in the world. And second, blockchain DeFi comes back up. When I say blockchain DeFi, it's when all these crypto boys comes with a fancy name of blockchain. That got stopped in 2022. It's not happening now, so there's no more threat unless it's World War III. Kaboom. So Mastercard, recession-proof stock. It's very close. It's under BuyTrigger. So how to buy Mastercard? Dollar cost average, no rush. And it's one of those, you buy now, don't expect to 10x. It's just going to grow really slow. It's going to grow better than your ETF or your S&P 500 long term because of the annual growth rate. But it's how we roll with very stabilized defensive stock. If you want to get a really high risk stock, you need to get a very defensive, keep the balance in place. That's how I see it. And it's very rare for me to see Mastercard on BuyTrigger. Okay. Finally, Apple. Apple is up 3%, is bringing the market out, is making everybody smile on the Friday. With the oil coming down, the market's propping up and Apple's coming up as well. Tim Cook bowing down from his reign as the CEO. We're all very happy, proud of him. We got a new guy coming in, young, energetic, the face of the company. But Apple, Tim Cook has done really well. The earnings in particular, the numbers looks like the numbers previously. Okay, there's only one number within the earnings. The iPhone decline, the China decline. And this time nobody complained. If you look back the last few years, every time you hear iPhone decline, boom, it's down, everybody rocking goes mad. But this time it's fine. But why? What has changed this time? It took a while for people, the last 2 years, for people to understand that Apple ecosystem is not just Apple iPhone. In fact, the second biggest revenue generator for iPhone just now, Apple, sorry, is the services. The services are generating the second largest revenue. We're talking about the Apple services, the cloud, the iCloud that you pay for, those services, the Apple TV, the Apple Music, those services are the ones that's creeping up. The Apple App Store that's making money off people selling their apps online. So those is chasing up, the ads, those is catching up, and now we know Apple is not just an iPhone company. But one thing that people are starting to accept is that the Apple ecosystem is strong. If any company were to be delivering AI to people on a consumer level, it would be Apple or Samsung or Google Android. Apple is the leading indicator. So people are starting to accept that Apple took the last 2 years. I know Siri is crap, but the last 2 years to enhance and prep the ecosystem with at least 12 gigabyte of memory on your mobile phone, minimum of 256 RAM. Why? Because if they were to install any local large language model like a local chat GPT on your phone, you can go offline and still use it. That's a minimum requirement, and the last generation spec and going forward will be that minimum requirement. Regardless of OpenAI or Claude or Gemini or Minstrel from France, that will be the next way forward. And then once they launch, they release the AI on the phone, that is when it's the mass rollout for the entire world. So people are starting to look at that spectrum. At the moment, Apple is at 4% growth by my calculation, 4% CAGR. The market is expected to be 24%. Huge, 4% and 24%. That's why Apple is pricing about $275 just now, because people are seeing that over 20% growth again, while the current value forecast is at 4%. So a lot of catching up, but investors believe that the demographic of people that owns iPhone will significantly not change, and therefore people are holding on to their Apple shares. So it's positive. It's positive for the technology. That's what I really care about. Okay, so that's the 3 stocks that I've shared. And finally, I really want to end my last session of my presentation here with the chat about the memory AI data center. Have you guys asked the question, why is NVIDIA not moving, but the likes of Google, Amazon, AVGO, maybe not AMD, all the memory, Micron, Hynix, Samsung, they're all rocking up so high. NVIDIA feels like the left out one. But I thought NVIDIA was the big tough guy, over $5 trillion company. In fact, they're 4.8 trillion and Google is 4.46, and Google could be the largest company in the world if this acceleration keeps going up. Investors are buying, pensions are buying, institutions are buying, sovereign wealth fund buying Google. And if it keeps going up like that, Google will be the biggest company in the world in a matter of under 8 weeks, I think. Is NVIDIA really slowing down? Dead. All I can share with you is the reason why NVIDIA is being held back just now is because of the, as you all know, the memory game. NVIDIA was held back by the COWS, where it's the wafer trying to put everything together, the packaging unit. At one point, that was the problem. but now it's the memory. So all Hynix, Samsung, Micron's memory are sold out for the entire 2026, and potentially they have already bought up everything that's 2027. So even if Taiwan Semiconductor can roll out as much Blackwell, as much Rubin, they are being held back by the demand of the memory, because the next generation CPU accelerator performance AI chip requires very heavy memory. It's holding back. This is why AVGO can start rolling out all the Trianium, the TPUs, the customized ASCII chip to the likes of Amazon, Google, OpenAI, Qualcomm. So all these guys are catching up just now. So it's playing the catch up where they were behind for 2 years. So I think at the moment as it stands, NVIDIA is the cheapest of all the AI stocks, because people forget that NVIDIA is pricing in robotics, the software, digital twin, predictive model, real software enhancement system in the AI world. Everyone's talking about agentic AI, but NVIDIA is planning for physical AI. This is what I'm messing up. But the whole point here in this chat is not about NVIDIA or who, but what I'm seeing just now on my data on my screen, which I will share a picture slide, is that Hynix, Samsung, and Micron's growth is exponential. Do you know that Micron and Hynix in 2023, the EPS was negative? Okay, negative. And Micron's, let me just scroll through. Micron's EPS is negative. Right? Micron's EPS in 2028 will be $27 per share. Okay, and Hynix EPS will be $217 per share in 2028, and Samsung will be $120 per share. That is simply incredible. Remember when you hear earnings where Apple, Amazon, they beat by 1.2 or 2.3 or 4, everything's under 5. These guys are at 217, 120, 27 EPS, earnings per share. Okay, I am not kidding you. I think it pushes their PE down. This is the forecast. So the forecast that I can see, 2026, we know sold out, the maxed out, max margin. 2027 forecast comes in, makes dwarfing everything. And then 2028, which is speculative, if you put it on the same trajectory trend where they are still short on memory, the EPS is just going to make Samsung Hynix like a very undervalued stock. How long can they hold this for? One of the key reasons why the EPS is high is because of the margin. For something that costs $1, for example, a mouse, $1, they're selling this for $100, making 100x, not really 100x, but the memory which is sold for $97 are being priced as $250, and then it's being bought in bulk. They double the price, triple the price, quadruple the price, people were buying it up. Okay, people buying up at 4 or 5 times the price. The same volume that was produced that year, people are buying out at 4 or 5 times the price. This is why it is rising, accelerating so high for Micron. But out of the three, SK Hynix is the biggest growth accelerator possible because they're specialized purely in memory. So SK Hynix is, if there's a bull and base case, SK Hynix has got the most upside. And I believe SK Hynix, if you're in the US or Singapore or anywhere, SK Hynix is not, and Samsung is not some stock that you can easily buy. But I heard from the club member that now on IBKR it's accessible. You can actually buy SK Hynix stock. Okay, and if you can't buy SK Hynix stock, I think there is an ETF. Okay, according to one of my members in the club, there's an ETF called DRAM, ETF DRAM, that's for memory. But the real question is it still time to buy memory stocks? Is it too late? It's gone 10x. SanDisk is $1,000. That I will share when I get the BuyTrigger allocated, because it's tricky because of the negative EPS. So once I get the value trigger, BuyTrigger, I'll definitely share with all of you guys out there. Once I get it added in, I'm still in rabbit hole, but I am impressed by the number, the forecast for 27, and then the forecast for 28 coming out. Will they hold for 29 and 30 going onwards? That's the question we ask. That's a risk that we take as investors. Is it a risk that you want to take? So many stocks out there. Meta is undervalued, Netflix is undervalued, ServiceNow is undervalued, CRM is undervalued, Amazon is just slightly beating the margin just now, and everything else, Master is undervalued, Robinhood is undervalued, SOFI is fair valued. So there's stocks that is what I do every day, looking and monitoring all the stocks. to see what's undervalued and overvalued. When I say undervalued, it means under the value trigger, which is an intrinsic calculation of the stock itself, not for just this year, but looking at the 10-year bandwidth, which is last 5 years performance, forward 5 years performance, forecast that we can make the best different base bull case, and then we assess over the years. This is the way I'm confident in the data that I see, rather than look at analyst data. When you look at analyst data, you notice that there's a huge deviation between one another, where they do endless spreadsheet and Monte Carlo method with the risk involved, which as an engineer, why do you do that? As for example, you start your car, you start your engine, and you try to assess the risk. What's the likelihood if I crash my car on the motorway at 120 miles per hour? If you send it to a mathematician, they're going to work out all the numbers. Just be realistic, man, engineer. Don't drive too fast. Change your tires. Don't overbrake. Don't oversteer. Just be sensible about it. And then you can have a good assessment how to be safe, rather than try to work 50,000 different ways on how not to crash your car. So there's a difference between mathematician and engineers. So that's my take. I'm not mocking anybody out there, but we just had to be realistic, because end of the day, you're investing your hard-earned cash and making sure that you get the right information and the right data. Okay, this is me. I hope you guys enjoyed this short segment. The market, I think, is literally open 15 minutes ago. You'll all go check it out. But next week, going forward, again, the star of the show will always be oil. Back in Christmas, December, the star of the show was dollars. January, February come, the star of the show was gold. And now the star of the show is oil. Once oil games goes away, fingers crossed, by June with the war, then the star of the show will be treasury bonds again. This is how we roll. This is how we understand. This is how we denoise from the market, and hope this is useful for everybody. Okay, guys, thank you very much and have a good day. I will try to share the short snippets and more BuyTrigger info on stocks which are at good value, especially the staple ones, built from ground up as always. Have a good day. Stay safe. Systematic investing. Bye-bye.